Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 18th edition of Market Outlook. So, quite the monster rally. It continues off of the September lows that were put in and those August lows that were not quite tested in the S&P. And let's take a look at where we are. First of all, clearly, this rally has now taken out that 50-day moving average. The 10-day, which is the cyan line here, has held nicely as well. But taking a look at this. The yellow line there is the 100-day moving average. A lot of hedge fund managers like to use that. Now, as a result of the rally over the last 7 to 10 days, we've now moved into a recovery phase. So you can see we went into that death cross. It happened after the huge drop in the market, so that really wasn't helpful in terms of the cross itself. However, it does give you a sense of overall trend. And as you can see, as we've moved up, we have what we call generally a weak recovery phase, because this 50-day moving average is still pointing sharply to the downside. Now, to be totally fair and unbiased and just look at the charts, a couple of things you can notice that we did have on the big move early in October off those lows, a good solid accumulation day. That was pretty powerful. However, since then, we haven't really had any true accumulation days, which is a day where you have an up day on good volume, surpassing the prior day in volume, and also the moving average of the daily volume going back. So overall, volume has been pretty light on the upside. So that makes things a little bit suspect. We're going to get into that in a little bit more detail. Now, looking at another chart here, which is going to be the weekly chart in the spiders, let's take a look at this. This blue line here is the 65-week moving average, and you can see we paused on by Friday's close just under it. How this acts around this critical moving average and the key resistance. The weekly charts are really telling the story, because you've got that weekly moving average, and just above it, the key level of resistance is around the 204 to 205 level. So could we eat into these lows quite a bit? Yes, but a lot of opens and closes occurred just a little bit higher. Let's blow that up a little bit more, and you can see just above 205 is where the meat of the action took place going back, and that is your key resistance. So just a little bit above that 65-week moving average, there should be some pretty decent size resistance there as well. So the market basically right now almost flat on the year, with the exception of NASDAQ, running into some pretty good resistance. And again, I hate to be predictive, let the markets tell us what to do. Let's look at some of the market internals and see what that is showing us in terms of how much energy it might have left in it. So if we take a look at the McClellan oscillator right here, you can see that we actually got a bit overbought. We had a small sell-off over the last early part of the week, which the market promptly recovered and moved up. So right now, you're definitely running a bit rich in the McClellan oscillator, but we moved from what we call an overbought area. We did get that little bit of a sell-off, and now it's working back up again and hooked up. So overall, I would say this is marginally negative in terms of the market breadth being a bit overbought. Now, interesting, you can see on the advanced declines, this is the lower chart here, that we are clearly about as overbought as we have been in the last year. So that is definitely a cause for warning. Now, one thing for sure is that you can work yourself off sideways, and oftentimes largely overbought readings sometimes go into sideways corrections. But we're going to add up some more evidence here. Now, interesting, we were talking about the volume spikes and the fact that we did have really one good accumulation day. But since then, you can see we got very, very overbought and now actually have hooked into a sell signal on our shorter term up-down volume indicator. So clearly the lack of tremendous volume or heavy volume to the upside in terms of last week's action and the action overall here is showing some weakness as well. So internally here, up-down volume, definitely a negative. The McClellan oscillator, which looks out over the next 2 to 3 weeks in terms of advanced declines, a little bit more on the negative side, and the overall advanced decline running pretty rich here. So, you know, your overall market internal structure definitely looking a bit rich. Okay, now let's take a look at sentiment in terms of volatility. Similar picture. Remember we were talking that we got really oversold, and once we moved above the moving average, we definitely were looking for a potential move to the upside and certainly an alleviation of the oversold readings at the October and late September lows. Now we're on the flip side of that. So sentiment is definitely getting rich. We're at the overbought levels. However, we have to really turn down and hook down to actually generate a sell signal or at least a warning here on volatility. So overall, you can see from our indicators, we're definitely running rich after this pretty massive rally. So running rich makes sense that if we start hitting the upper end of those weekly moving averages in the S&P and levels of resistance, that a back and fill is definitely in order at a minimum. Let's take a look at a couple of other charts as well. Let's take a look at GDX and gold. And most interesting is GDX on the daily charts. Couple of things. You can see that we've actually moved off these lows, which was about 13 or so, traded all the way up to just about 17 on Friday. We got long at the in our Advantage product at the 14 level, have been peeling out of this thing as we attack the upper end of the Bollinger Band and manage our profits and risk. But overall, this is a pretty good size move. We got, what, an 8% move off the lows in the S&P, a 20% move off the lows in GDX. So looking like a potential bottom here on GDX. GDX itself, very, very bombed out chart. Gold miners, very bombed out. Not surprised to see this type of move. But interestingly as well is gold is even stronger. So what we did do is we moved up about $75 to $80 an ounce in gold bullion, which equates from this low of 105 to 113, 114 level. And we did close a couple days above that 200-day moving average, but we're running a little bit rich. So what's interesting here is as the markets, the equity markets rally, seasonally gold is moving into a pretty strong period, and it's possible that we've broken the multi-year downtrend, which is interesting. Gold miners starting to outperform the equity indices at this point in time. So that is something definitely to keep an eye on here. Let's see how gold plays out. Now, look what's also interesting is we should have some support, some pretty good support at the 108.50 to the 110 level, and this we're in a recovery phase. Up until Friday, we were really more in a accumulation phase, but it backed off on those overbought readings here on the relative strength index. So, and also the Bollinger Band as well. When both of those get overbought, generally the market's ripe for at least a short-term correction here. So I'm looking for the gold to basically hold this 110 level and certainly hold at this rising 50-day moving average. So I think it's worth noting that gold in this type of environment at the moment and gold miners acting quite well, and in fact outperforming the S&P by most measures. And interesting, you can see in August, right, when we had that huge sell-off, gold actually rallied while the equity markets were selling off. So that's an interesting observation here. The fact is that might lend credence to a potential, certainly a deeper correction in the equities market might be brewing after it works off this it's a positive sentiment at the moment. One last thing, let's take a look at the euro, because this action here could also be supportive to the gold market and equities market as well. Okay, well, first thing to notice is for the first time in quite some time, the 50-day moving average crossed above the 200, right? So what we've now moved into is sort of a funky bullish phase, because the 200-day is still pointing down, the 50-day is up. I like to see the 200-day actually rising, but look at this overall pattern. During the panic in August, euro actually got really strong. So lots of sideways action, almost looks like convoluted, somewhat of a head and shoulders bottom here, with a very deformed right shoulder, but nonetheless, or cup and handle type of pattern as well. You can say that, but more importantly, you got this 50-day rise in the 50-day moving average on the rise, bullish cross, and all this sideways action. If we can clear the highs of last week, we could be off and running in the euro. That would be supportive to higher gold prices and equity prices as well. So that's it for now. Stay frosty. This is October, an extremely volatile month and unpredictable. And so keep your stops relatively tight if you think you got some risk-on positions. And let's see what this week brings. Thanks, and see you next week.